This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this StockBox interview.
Nostra Terra have provided an update on the operations at the Pine Mills oil asset in Texas, with highlights including the completion of the Phase 1 workover program, increasing production by 30 barrels of oil per day at Pine Mills, a 60% boost. And now company production averages 120 barrels of oil per day, including output from the 5 revived wells and the Fouke area. Well, joining us today is CEO Paul Welch. Hi, Paul. How are you?
All right, great. Thanks for having me. Good to see you again.
Yeah, good to see you again. It was before the summer we spoke. I know we did a deep podcast on you and your background, really what you wanted to achieve at Nostra Terra, and it was all about this sort of workover program. So now that workover program is complete. You've obviously been working on that throughout the course of the summer. Could you perhaps just tell us a little about what the workover program involved and what that increase of 30 barrels of oil per day really means to the company?
Sure. So, when we originally talked, I think I told you at the time that there hadn't been a lot of investment in the field because the company, the previous management team is looking kind of further afield. They're looking for new assets, new countries to enter and that sort of thing. And the cash cow that provided all that, liquidity for them to do that was essentially Pine Mills. So in our view, it had been neglected. And so what we wanted to do is kind of reverse that and essentially put money into it because we thought it was a great asset. So, we did that. We raised a little bit of money. We did these workovers. And what we found is that not only did these workovers work, but there are others out there that we think we can also bring back profitably as well. So at the moment, we returned 5 wells to production. We've increased production on an average of 30 barrels a day. So the field was making 50. Now it's making 80. The Fouke wells and some stuff from West Texas contributes to the remainder. But the part that probably didn't come out in the update today is that we still have another 15 to 30 barrels of production increase to expect because we also restarted the water injection in the northern part of the field that had been shut in for 2 years. So because it had been shut in for so long, it's going to take some time to repressure the reservoir and to start driving oil back to the producing wells. So we expect by the end of the year, beginning of the first quarter, we're going to add another 15 to 30 barrels a day. So almost double where we are at the moment. But at the moment, what does this mean to the company, this 30 barrels a day? Well, it means an increase in revenue of almost $500,000 per annum. And our market cap at the moment is right around £1 million. So it's very, very important to our bottom line. And I think as we put in the press release, we are now cash flow positive at all levels, right? So we're making money at $70 per barrel at WTI price. So we're in really good shape, whereas before I think we were struggling a bit. So the whole workover program has kind of delivered on what we'd said, and we think there's more to deliver there.
Okay. Well, yes, I did do some sort of quick calculations there when you talked about the increased profitability in the net backs there. That's $44 at Pine Mills and $63 at Fouke. So I averaged the two of them getting sort of $53 just across as a general average here. You've said you're profitable, but timesing that by 120 barrels of oil per day, that equals 6,300 Circa dollars per day there. So just taking that over the course of a year, accounting for perhaps not 24/7 running times. Is it fair to say we're sort of talking here circa 2 million revenue per year?
1.8 to 2. It depends. We're going to see some decline over that period. So, the field's been declining at between, 5 and 6% per annum. So we won't get all that, but your numbers are spot on. We're right in that ballpark. So again, that's why you can see that $500,000 that we added is a really important part of that.
Yeah, okay. And when you talk about workover programs, what does it involve exactly? Is it well optimization, or does lots of factors come into play here?
So it depends on the well itself, but because they had to invest in the field. So if a pump went down, a well had a casing leak or a tubing leak or something, the field didn't repair it because they didn't have the money to do it. So a lot of times what we're going in, we're just bringing a workover rig in, pulling out the tubing, putting in a new pump, rerun the tubing back into the ground and starting the well up again. Sometimes it's been down for so long that we have to clear out the location, do some electrical work, lay some new lines. So it depends on the well. But generally, we're not drilling a new well. So, we spent, let's say, between $300,000 and $400,000 to get 30 barrels a day back on. that's a hugely profitable piece of business for us. So, rather than drilling a new well, which costs, upwards of $1 million here, we returned 5 wells to production for, between $300,000 and $400,000. So that was really important. The other thing too is that it hopefully came out in the press release. We also reduced our operating costs by about 25%. And that was super important too, because now, all these barrels that we deliver, because the overhead is basically fixed, that new revenue stream, is just hugely profitable to us. So the remainder of the funds that we raised went into the facilities. So we improved those. There had just been some maintenance that hadn't been done in a long time. So by investing in the facility itself, we not only did we improve it from a maintenance and safety perspective, but we also improved its efficiency. So the same stream of water and crude that was going to the facility before was delivering X, now it's delivering X plus a little bit of Y. So there's also some efficiencies gained there. So across the board, it was a really important program to deliver, because there hadn't been one, as I said up front, about 5 years.
Sure. Okay. Well, that's good to know. So for about 300,000, you got those extra 30 wells, worked over and producing.
30 barrels. Correct.
Yeah, exactly. So then on the enhanced oil recovery, where you talked about reflooding and repressurizing the well there. So you're expecting to do that sort of, you say within the next 6 months, is that all costed for a similar sort of amount?
It's already done. So what we had to do is we had to reconnect the injector in the north. We've done that. And so, when we connected, so the field was operating at a particular pressure, let's give you the numbers, like 2,000 PSI. When we put the well back on, started injecting again, it was at essentially atmospheric zero pressure. From the time we started until basically this weekend, the pressure went from 0 to about, or I think we're at 1,500 PSI. So we have another 500 PSI to go. To get back up to the operating pressure we initially were. And once we hit that pressure, then we're going to start driving, in our view, oil to the producing wells, and we'll start to see that increase in production. So we've given it a range between 15 and 30 barrels per day, and I think it'll take, 6 months to get to 30, but we'll start to see that 15, come in increments. It'll be, 5, 6, 10, 12. It'll ramp up over time. But, once we hit that 2,000 PSI mark, which should be at the end of this month, beginning of next, then we'll start to see incremental increase in production from that particular aspect of the workover program.
Okay. And that's 6 months' time to get to about an extra 30 barrels of oil
per day.
And that's all costed for. There's no extra real big costs involved in that at this point.
Zero. No, it's all done. All done already. Yeah. Okay. So that was, and when we look at the importance of this workover program, that was job number one. We almost did that the first thing, because we knew we had to get those barrels back in the ground, because there are 6 wells in the northern portion of the field that really dropped off in production. We lost 30 barrels a day. And so we're trying to get back that 30. If we get somewhere between 15 and 30, we'll be happy. But that was, essentially job number one. The other wells that we returned to production were secondary to that. So the first thing we did was return the injector to production, basically.
Okay, and then in terms of sort of general plans, then of course you did raise a lot of money. I know it was quite a big discount back when it was done a few months ago, but that's the state of the market, unfortunately, at the time. But you've got some cash left in the bank, I would assume, and of course you're talking about new development potential here with reserves identified and targets under evaluation in the Fouke area. So let's look at, is there anything to look forward to before year end, or really are we talking sort of H1 next year, as well as bringing those extra 30 barrels on per day? What else are you going to be focusing on?
Right. So I think before the end of the year, we'll start to see some more barrels be delivered from the waterflood. So, whether it's 5 or 10 or something. So that's what we expect. In addition to that, as we said in the press release, we also have, essentially mapped out another Fouke location. So it's north of the 2 existing wells. That's there. It's got between 200,000 and 300,000 barrels recoverable, we believe. And so, again, in that area, we are 1/3. We have a partner that's 2/3. So we have to, work with them to see, what they want to do in that area. We'd like to drill a well in the first half of 2025 in that area. That well will be about $1 million. So our cost will be roughly 300,000, 350,000, completed. And so that, we could see in the first half of next year. But in addition to that, as we've, increased our cash flow, we've identified more workover candidates. We'll start doing those at, 1 and 2 at a time, right? This first program, because we had to get, we had the money, we did, all of them at the same time. And we got, economies of scale there. Now that we're generating cash, over time, we should be able to tackle ones and twos. It'll depend on how things go. But at the moment, that will be our plan. So we'll just incrementally increase production as we go into 2025. In addition to that, beyond the Falk area, we have this whole 3D that maps over, that's been completed over the entire field 3D seismic program. In addition to Falk, there are 2 other areas where we've seen some Clarksville potential in isolated fault blocks that are similar to the Falk area. So we will continue to develop those as well and see if we can put together, let's call it a drilling package. That's more than one well, maybe up to 3 wells. But again, that will depend on the technical work that needs to be completed and then the state of the market at the time. But so I think the important thing here is that there's a lot to do in Pine Mills, and it just hadn't been done in the past, hadn't been focused on. So by focusing on it, we're uncovering things that, we didn't expect. So as I put in the release this morning, it's a jewel that we expected good things from. And I think we're going to find that there's more there than we originally thought, which is a good thing. I mean, the best place, it's the old adage, the best place to find oil is where you're producing it. And I think we've proved that to ourselves through this Workover program, that we've definitely found more potential in an area that's been producing for quite some time.
Okay, good. So we can look forward to perhaps seeing a new well being drilled in H1 of next year. And I think you said before that the idea would be to sort of reinvest cash effectively, so you would less reliant on the market. Would that still be the case? Yeah,
if possible. I mean, yes, that's what we'd like to do. Again, it'll depend on oil prices, depend on how things go. But yeah, that ideally, it's the best source of funds is things you internally generate. So that's what we'd like to do. So between drilling a new well and the workover candidates, the funds will be put into that. They won't go to dividends or buybacks at this point. We're just trying to generate as much cash as we can, because these opportunities, are from an IRR perspective, above 100%. I mean, they're amazing, and so we want to continue to put money into those type of things.
Sure. And the loan as well, was it a priority to sort of start paying that back a little bit? I think
we'll start paying it back. We're paying interest on it. The nice thing about so we have a new president in the U.S. I'm in the U.S. As you're aware, and so with what the previous president has done and what the economy's done, and what the Fed has done. Interest rates have come down, so the coupon on our loan has been dropping, and so as a result of that, our payment per annum per month has dropped as well. So as those payments continue to drift down, as the prime rate drops, we will pay less on that loan, and then we'll start to pay it down at some point. We haven't decided that yet. As long as we have, opportunities in the field that have these high IRRs, we'll continue to invest in the field. But at some point, we will start paying it down. But at the moment, it's not much of it's a burden, but it's not a huge burden, and it's getting less each month as the rates drop.
And one final question, Paul, just to finish off here. So we talked about the circa 2 million of profit per year, really. The market cap is about 1 million at the moment. So you're already sort of trading at really a 50% discount to net profitability. What's the sort of overall ambitious goal from your point of view with ntog here to really, I know we talked about turning the company around. That's what your sort of motivator is. So give us an idea of what we can expect from you.
Well, you're in London most of the time. As we're listed there. It's not mind the gap, it's close the gap. We have a large NAV value of in excess of $10 million, and our objective here is to close the gap there. We need to get closer to our NAV number. As we add barrels and we add revenue stream, that'll happen. So our goal is to close the gap. And the gap gets bigger as we keep creating value. So it's closing that gap, raising the share price. Seeing benefit for our shareholders that have followed us and invested in us. That's what we need to deliver, and we think we can do that through the program that we've initiated.
Okay. Well, thank you very much for your time, Paul Welch, the CEO of Nostra Terra Oil and Gas.
All right, thank you. Appreciate you having me on.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stockboxmedia.com. Thank you for watching.